Hey everyone, this week I'll address the top questions investors have been asking about interest rates. Then I'll share Wall Street's current rate predictions for 2025 and how interest rates could shape the commercial real estate landscape in the coming year. So on September 18th, the Fed reduced rates and they went big with a 50 basis point reduction. Which brings me to the top question from investors. Why did the 10-year Treasury go up after the Fed cut the overnight rate? Part of the answer is that the Fed reduced interest rates on the very short-term lending, literally the rate the Fed charges banks to borrow money overnight. And although the many different US Treasury rates tend to move in the same direction like an unruly herd, they don't move in lockstep. The timing and magnitude of interest rate movements of various maturity terms can vary, and they can even go in opposite directions over the short term. So over the short term, the 3-month Treasury could go one direction while the 30-year Treasury could go another. But the rates do tend to migrate in the same direction over the longer term. Wall Street investors are another factor driving the rate disparity. Basically, the 50 basis point rate cut was already baked into the bond pricing, and once that expectation was validated, the market pricing adjusted from there. And the third reason the 10-year Treasury increased after the Fed rate cut is because some investors view the 50 basis point cut as a sign the Fed is concerned about recession risk. And since that 50 basis point reduction, I've seen a lot of investors citing a statistic that, on average, 18 months after the Fed starts cutting rates, a recession follows. The key word here is average. Since 1990, setting aside the COVID cuts, the Fed has cut rates 6 times. And while recessions follow the cuts by an average of 18 months, the spread has been significant. It took 69 months for a recession to form after the 1995 rate cuts, which was arguably a soft landing, while a recession started immediately after the 1990 rate cuts. So take that 18-month factoid with a grain of salt if you run into it. In addition, investors should consider that we're in a pretty unique situation compared to the past rate reduction periods. We're still adding jobs, the unemployment rate is still low, retail sales are still positive on an inflation-adjusted basis, total cash savings, including money market funds, are at a near record high, even when accounting for inflation, and labor productivity has sustained its upward trend. So the rate cutting climate we're in right now is arguably different this time. But where does that leave us? If you look at the longer term Fed watch, Wall Street's anticipating the federal funds rate will move to the mid 3% range by summer next year and reach 3% by the end of 2025. So Wall Street's betting the Fed will continue to cut rates. And if that comes to pass, it'd be good news for commercial real estate investors unless it's accompanied by a recession. Ultimately, I think Wall Street's being a little aggressive with its rate assumptions, but only time will tell. Regardless, based on Chairman Powell's statements at the September 18th press conference, we should see additional rate cuts over the course of the next several months. And that's already spurring some aggressive bidding activities on some multifamily, industrial, and retail assets, especially in northeastern and west coast gateway markets, regions that didn't get as much pricing pressure or development in the last cycle as the Sunbelt markets. Institutional investors, many of whom have been on the sidelines for the last 18 months or even longer, have begun to re-engage, and the investment climate's shifting again. Now, some prospective sellers may try to hold out for cap rate compression, but depending on the assets and the location, this could be very speculative. Yes, falling interest rates could spawn downward pressure on cap rates, but to get there, we need to see an aggressive buyer pool with ready access to relatively low-cost debt capital. And we're not there yet. Whether we get there, that's still up in the air. So from my perspective, the commercial real estate market has shifted gears, and the outlook for most property types in most markets is generally positive. Will it get better? Maybe. But while the road ahead looks positive, some risks are still out there, which is why investors need to keep their eyes on the horizon.